Welcome to ZoomOut, and this is your Q4 2025 Outlook. As per usual, this presentation is for your entertainment only. It's not investment advised. Remember, I'm biased and have blind spots, so definitely do your own research. Looking back at my June predictions, we pretty much hit it right on the mark. For my updated forecast into the first half of 2026, I see a mild slowdown with rising unemployment, rising inflation, but Trump's stimulus and strong corporate earnings into Q1 that'll keep the market from collapsing. I think the US dollar will weaken into 2026, but in the second half of 2026 with midterm elections, I see continuing economic erosion, but I also believe that Trump will do everything he can to prop up the stock market. Too much has happened in 2026 so far to review everything. So we're going to really zoom out and look at structural shifts globally and in more detail, the US and China. First, I want to highlight that the economic pie grew from 1980 to 2000, but it's been shrinking since then, and I think it might continue to shrink into 2035. What that means is we've created wealth gaps and disparity. It's creating conflict internally. We're shifting from a unipolar one US superpower into a bipolar world where the US and China dominate global affairs. We used to globalize and collaborate, but I think we're shifting towards the deglobalize and compete. It used to be economic power was primacy, but now with this conflict with China and the US, innovation power has come to the forefront. We used to think about making things all over the world and just-in-time global supply chains. But now we're talking about putting up barriers, being self-sufficient, reshoring industrial capacity back into our homelands. Overall, because of the conflicts in society and wealth, we used to decentralize and democratize, but now we're seeing a global trend towards centralization and autocratization. We used to talk about making things and broadcasting them globally, commoditizing things. But now with modern technologies and the infrastructure of social media, we are talking now about personalizing things and finding your community. In the past, knowledge and intelligence, it was compartmentalized. Lawyers could be lawyers, doctors could be doctors, accountants could be accountants. But with the advent of AI and how fast and rapidly it's improving and expanding, knowledge and intelligence is going to be abundant in the future. This is going to change how we live and have careers and have a life. Similarly, labor was limited. We could only have that many kids around the world, and demographics really was a foundation of all economic growth. In the future, robots are going to be readily available and cheap enough that we're going to have abundant labor, which again is going to structurally change the social contracts and what work means and what money means going forward in the future. I just want to add a couple of thoughts. The shift from one superpower to a bipolar world inherently means that countries and people will be forced to pick a team, choose a side. Smaller countries will try to play both sides and be like Switzerland, but both the US and China will make it impossible for larger countries to avoid joining an alliance. Meanwhile, the innovation war will be broad spectrum and develop so fast that many humans will not be able to adapt, unlike past tech boom cycles. I mean, replacing horses with cars took years, but replacing interpreters took months. The speed of innovation in AI also enables rapid innovation in space, robotics, healthcare, material sciences, etc. At the core of this innovation is also the sophistication and the number of human engineers and visionary business leaders. Many see this tech war as determining who will be the next superpower for the rest of the century. Looking at GDP, which is a proxy for economic growth, the US is still in pole position and is still larger than China, Germany, and India combined. Don't know if you remember, but less than 5 years ago, there was a real fear that China's GDP would overtake the US. Clearly that has not happened, and due to China's demographic challenges, I suspect that the US will slide but remain the largest economy into 2030. Debt is a global problem, and countries have flagrantly ignored prudent guardrails. Yes, we had a global financial crisis in 2008 and a pandemic in 2020, and countries responded like helicopter parents and printed up so much money in debt to dampen the pain. Problem is, we are reaching and exceeding prudent levels, with most of the developed world above 100% government debt to GDP. This means that if you earned $1 million a year, you would also have $1 million in credit card debt as you spent $2 million a year. We all know this doesn't make sense and puts us at risk if something unexpected happened. But right now, since everyone is doing it, no one is getting punished for it. How long, however, will we turn a blind eye to this obvious risk? In the last slide, the US government debt to GDP was about 120% compared to China's at around 100%. This isn't the total picture. When we look at total debt, which includes both government and private debt, China is approaching 300%, while the US is around 250%. So what does this mean? Remember, governments can print up as much money as they dare to pay what they borrow. But companies and households cannot. In this picture, China has much higher debt risk compared to the US. Similarly, global liquidity in dollar terms has been growing steadily since 2009. Now, do you see the drop in 2022? I remember 2022 as a year when both stocks and bonds dropped 20%. Here's a fun chart that shows some tectonic shifts in the global financial order. Since Trump, the world is playing defense against the US leveraging or freezing their financial reserves. Gold is global and apolitical, making a preferred reserve asset if you're worried that Trump might do something. Gold has run over $4,000 per ounce and has recently come back down, but I don't think the motivation to boost gold holdings has dissipated. Another fun chart reminding us that not everything in the world revolves around the US. Most stock markets around the world have handily outperformed US stocks despite the fervor of US tech. This is quite telling. Foreign investors in US stocks did not disappear, but clearly investment dollars are finding new, friendly places to grow. US dollar weakness is a tailwind for international stocks, but even in periods when the US dollar has been strong this year, investors are not fleeing international. Now, AI and the build-out of AI data centers is incessantly on the news, but it takes a lot of stuff to actually build one. Obviously, the NVIDIAs or AMD chips are needed, but so is electricity and building materials and water. This slide shows that one data center needs about 2,000 tons of copper. In the US alone, we are building like 500 data centers. So globally, we're building data centers and power plants on top of a continuing shift to electric vehicles, albeit mostly outside of the US now. There's a huge structural demand for copper as the world electrifies and AIifies, but it's not just copper. Broadly speaking, the pandemic shut down global mining, so I believe there's a structural imbalance between supply and future demand. Now on a different topic, global sovereign debt yields have been climbing all year. This concerns me. Basically, this means that, for example, when the US wants to borrow money by selling a US Treasury, investors either don't want them or don't believe in them, thus forcing the US to increase the yields to make it more attractive to sell. Does this mean that global investors expect government interest rates to be higher because they expect higher inflation? Or does it mean that faith in government's ability to manage and grow the economy has diminished? Remember, government debt to GDP levels are egregiously high all over the world, and it doesn't look like any government has a plan other than to print more money. Now let's dig into US-specific shifts that I see. Truthfully, any president would be faced with these challenges and likely made similar choices. The difference is in the execution. With the COVID pandemic, we got a bigly fiscal stimulus package from Trump 1.0, which eventually showed a growth of the economy and liquidity that boosted the economy and also boosted inflation. Now those effects are wearing down and we're going to see a flattening of the effect. Now, with Trump 2.0, I think he started like my original predictions as the rip the Band-Aid off, he's the austerity Trump. He was going to cut and decrease economic activity, decrease spending impulse. He wanted to slow the economy and the markets down. And he wanted to focus on fixing the budget, et cetera, et cetera. I believe we've made a shift now. I think he's changed now into stimulus Trump, where he no longer wants to focus on US Treasury yields, but now wants to focus on US stocks. His tariff war, he launched it, made a big impact, but you're seeing clear signs as deals get done and with recent negotiations with China that he's now deciding to de-escalate and simplify the whole exercise and the whole impact. It's created a lot of uncertainty. It's slowed everything down. He wants that behind him so that he can grow the economy into next year for midterm elections, as well as for the rest of his term. The typical Republican deregulation, pro-business, yeah, that definitely is still part and core of the Trump administration. However, you're seeing a clear shift into specific focus sectors for national security and self-sufficiency. So stimulus programs for the semiconductors, for rare earth metals, for quantum computing, for shipbuilding, et cetera, et cetera. These are government interference decisions that have a lot of money and a lot of government support. He's clearly not deregulating. He's actually enforcing and pushing certain sectors for what they believe are national security reasons. This makes sense and actually probably would have happened whether the president was Trump or somebody else. We also see Trump shifting away from America being the defender of democracy and the global cop to America first and a rent-a-cop. We don't provide the security guarantees that we used to unless you pay for it. And that is to boost sales, it is to reduce costs and reliance on the US. Trump is telling the rest of the world, you're on your own. If you want to be a friend of the US, you're going to have to play game, buy our exports, buy our defense weapons and things like that. That's the only way he wants the future to look. I think it's also interesting the attitude towards China, where Trump started with China is the enemy. We're going to defeat you. We're going to use everything, escalate tariffs to 150%. And clearly, he's backed down from that position. I think he has realized, or his administration has realized, that at this stage, we're too intertwined. China has a stranglehold on rare earth metals, magnets, batteries, et cetera, other things, that it's too soon to break the world into two like that. I think Trump has shifted to China as a competitor. We're going to coexist with them, bide our time, build our competencies so that in the future we're able to more decouple with China. You're seeing the foreign policy shift also. We used to be very North America centric, Europe centric, Western alliance centric. Trump has decided that no, Europe, Ukraine, that's an issue for NATO. We're not going to be the ones that are fully engaged and fully responsible for the cost of that war. Europe has to take over that responsibility. By saving that money, he wants to refocus all his energy on containing China, developing relationships with Asia, and you're seeing also very specifically this recent attack on Venezuela and the drug cartels. This is a policy shift, I believe, to bring in South America as a partner and alliance for the next 20, 30 years. There are many reasons why that makes a lot of sense. I know I've spoken about it at least maybe 10 years ago. Geopolitically, having North and South America aligned in one big alliance with a lot of young people, a lot of natural resources to work with the US. If North and South America were aligned, we really don't need the rest of the world. And I think it's actually a fairly smart policy decision to start to focus and bring that alliance and that structure into the US foreign policy. Our economy right now is a so-called K economy. The wealthy 10% can afford the inflation and continue to spend because their homes and their stocks keep going up. The rest of the economy that doesn't own a home or stocks is suffering high inflation. Americans were already more optimistic and complacent compared to the rest of the world, but the lack of savings and easy availability of credit has pushed most Americans to live paycheck to paycheck. Over 50% of states in the US are in recessionary territory, making this a really dangerous mix. Average hourly wage growth is something we need to watch. Trump's immigration policy has drastically reduced the labor force, which should create upward wage pressure. However, if the economy is weak and companies aren't hiring, wage growth, as well as the unemployment rate, are likely to stay range-bound. I'm leaning to the range-bound scenario, and I'm worried that inflation will climb into mid-2026 before leveling off. Although a backward-looking indicator, consumer sentiment has been very, very weak. It's the direction of the trend, and it's telling us that Americans don't feel good about the economy, jobs prospects, or spending impulse. When the US economy is 70% driven by consumer spending, this is a worrying signal. On the bright side, the AI boom is real. Big tech is putting their money where their mouth is in a massive investment in their futures. We're talking trillions of dollars over the next few years. This obviously creates some jobs and drives economic activity in sectors that support this build-out. Outside of this AI build-out, however, the rest of the economy doesn't look that interested in building or expanding, reshoring, or investing in the future. The tech build-out will support the broad economy, which is why I don't think we go into a real recession. But until jobs grow and or inflation comes down to support consumer spending, I would, as a CEO, just sit and wait. Why take the risk when government policy can flip-flop over a tweet? A map as confusing as Tokyo's subway system. We're now seeing an incredibly incestuous financing relationship among the biggest AI players. Not a concern right now, but if any of the big bubbles were to have an unexpected, catastrophic issue, the whole house of cards would have issues. This is a systemic risk for the world, and at its center is NVIDIA. With the passing of the Genius Act, I need to mention the potentially massive impact that US support for stablecoins could have. Although based on the same blockchain technology, stablecoins are unlike things like Bitcoin or Ethereum in that they are 100% backed by a real asset like a US Treasury or US dollar, and are therefore completely stable to the extent that the dollar and the Treasury are stable. We're going to see immense innovation in finance and money as stablecoin markets and applications broaden into consumer markets. We need to watch this sector. Meanwhile, JP Morgan, one of the biggest crypto skeptics, has done a 180 and will start to accept crypto as collateral. If JP Morgan does this, all of Wall Street will follow. This is earth-shaking, lending legitimacy to digital assets and further entrenching cryptos as a real asset class. If any institutional investor were on the fence about crypto, now they have a green light. And if institutional investors make crypto even 1% of their portfolio, the supply scarcity could drive nosebleed returns. Finally, recently, we're seeing news about the newest and baddest ass aircraft carrier being sent to blow up little Venezuelan drug-running boats. Why bother? Because the US wants to kick out Chinese and Russian influence in the region, and the US wants to step in to become best buddies with nearly 1 billion potential customers and trillions worth of natural resources and metals. Why bail out Argentina with a 20 billion swap line? Because Trump needs a champion to advocate for US integration in South America. This is the long game in geopolitics, but I suspect more US policy and treasure will go towards developing this potential alliance. Now let's talk about the shifts going on in China. China boomed after they were accepted into the WTO in 2001. After the financial crisis in 2008, they poured on the stimulus and kept themselves and even the world from a worse fate. The massive debt, however, started to make the economy sluggish. Then Xi took over in 2013, massively centralized power in China, and now dictates top-down directives on all aspects of China, domestic and foreign. China's GDP has fallen from 15% to 5% under Xi's reign so far, and the COVID pandemic, the deliberate popping of China's real estate bubble, and the now US-China conflict has mired China in a slow growth, no consumer spending, export only economy. The wealth gap in China has widened significantly, especially between the rich coastal cities and internal cities. The one-child policy has now been removed and is morphed into have as many kids as you can if you can afford it with some government support. China is aging quickly and is going to be an elderly demographic soon enough. China, alongside the US, has morphed into a high debt society, high debt country, into an extremely high debt country. Broad industrial manufacturing overcapacity has now led to a new word called involution, where China is very much worried about internal competition dragging down prices, overcapacity leading to smaller margins and low growth. They want to shift that into a more advanced manufacturing economy, even having overcapacity to support the world. Overall, during this transition of a super strong centralized government led by Xi, there have been cracks forming in 2025. China watchers have been watching carefully Xi's actions, the fact that he's let go a lot of his generals that he himself appointed. There's a much palace intrigue going on right now concerning whether Xi is still healthy, whether he's losing power, or what's going to happen going forward. On the plus side, it's very obvious. The last 5-year plan that they produced, they've pretty much achieved everything they've wanted. They have become tech innovators instead of copycat tech innovators. They have been export oriented, but now they're going to focus on boosting their domestic economy, work out how the real estate bubble destroyed so much wealth in China that now they need a new mechanism for Chinese citizens to feel wealthy. And that looks like they want to focus on the stock market. Another major change that they've shifted from, they were so dependent on energy, importing that from all over the world, risking the bottlenecks, the shipping bottlenecks that America controls. Right now, they've promoted so much internal development. They are energy abundant. That's a mix of green energy. They're the world leader in solar energy power. They're building 50 nuclear reactors on top of still using coal and oil and natural gas. But having so much energy, they are very, very well positioned for this coming wave of energy demand from AI data centers, and full electrification of their vehicles and autonomous vehicles. Since Trump 1.0, China has become an unattractive investment destination for Western alliance countries, especially after China's support of Russia in the Ukraine war. With Trump 2.0 going after China again, you would have imagined that their stock market would be moribund, but the reality is it's blown up this year, about 2 to 3 times the S&P 500's performance. Xi has released the tech sector that he had put in jail originally. DeepSeek shocked the world with its highly effective and excellent AI, and deregulation in China's financial system has allowed more institutional money to flow towards stocks. China needs a growing stock market for several years to restart the consumer wealth effect that it destroyed when they popped the real estate bubble. This is now policy, and I believe they will do everything they can to keep it going. This is a mind bender. Due to the pandemic, the rest of the world pumped fiscal and monetary stimulus to support their economies, which created massive inflation. China, on the other hand's lockdown policy restricted and hampered stimulus to the point that they have been experiencing deflation since 2024. It means their overcapacity has forced factory owners to lower prices to keep afloat. Deflation is a tricky problem for economists because when you have structural deflation, consumers are rewarded for waiting to buy. Over time, the waiting causes a vicious cycle that slows consumption, economic growth, and wealth creation. So we've taken the space station view of the world. Now let's take a 30,000-foot view. Starting with the US, here's my list of headwinds and tailwinds that I see into mid-2026. Looking at headwinds first, CapEx means spending on equipment, facilities, and people, and companies only do CapEx if they expect the future will be rosy and need what they are producing. I think AI CapEx is now priced in for stocks, but non-AI CapEx still hovers at lows. As much as Trump wants to create a world where Americans reshore all manufacturing back into America, it's simply not happening. And we don't know outside of AI and semiconductors how long this keeps going. Meanwhile, we're starting a real pickup in corporate layoffs this fall, and probably will continue as AI productivity becomes more prevalent. It gets spread across all the Fortune 500 companies and into the broad mainstream US businesses. We're simply not going to need as many people as we did before because productivity of AI has boosted their ability to produce a lot more without the headcount. This is a negative, obviously, if we have a higher unemployment rate due to AI. I'm also really concerned about inflation into mid next 2026. I think that a lot of the tariff effects, many Republicans are saying, well, look, it didn't create any real inflation in the US. Our economy's still going well, blah, 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 blah. I think the real impact of tariffs are starting to show up now. Um, the inventory that we have now was purchased before the tariffs happened. We're going through them. We're not going to order as much as we did for this Christmas season. But as companies run out of their inventory and they need to restock, they're going to run into tariffs. And we're going to be offset by higher import prices, obviously. But there are many other things that go into inflation. So the following slides will show you some of my concerns, but uh, let's just say that I think inflation is still sticky. It still wants to rise into 2026. Probably peaks out in 2026, but then we're still going to have to deal with those economic effects first. Trump's tariff war against the entire world has also created a new dynamic where countries are quickly making trade agreements amongst themselves, excluding the US. So, trade with the US, I totally can imagine that US imports will fall. Trump is pushing hard to increase US exports. We'll see how that goes. I think that works to a certain extent. But everybody outside of the US orbit here, they're increasing trade amongst themselves and excluding the US. In the long run, this could be a very detrimental thing for the US. And finally, I want to touch on the fact that despite hiring Elon Musk and creating Doge to cut the US budget deficit, we've shifted from, let's cut $2 trillion, and we've actually managed about 200 billion, which is nothing that actually affects the US budget deficit. Second, I have a sense that Trump has abandoned that whole idea. He can't cut Medicare, he can't cut Social Security. We really don't have much room to cut. However, the cost of keeping our military strong, this is expensive stuff. And I think the budget deficits actually start to rise under the Trump administration. In order to maintain the national security, I get it that we need to spend on that. But overall, the budget deficit probably wants to rise in the next couple of years, creating a lot of funding pressures and challenges for the US government. And it also detracts from our faith in the US economy, faith in the US dollar, faith in US treasuries. We're seeing that reflected in the global financial flow of things, and that has a negative effect in the longer term. Now, on the plus side, as I mentioned, AI productivity is actually something that is tangible and shows up in earnings. And I do expect a nice bump in earnings for all the companies that quickly adopt AI, lay off a lot of workers. They're going to see a nice earnings bump probably into mid next year. We also can't forget the one big beautiful bill, we call that OB3. The fiscal effects of that are very much tax oriented, and we're going to see that effect show up in tax season. So beginning of next year, there's going to be a fiscal bump from lower taxes and entrenching the Trump tax cuts into the tax policy for the future. So we're going to probably have consumers with bigger checks coming back to them, and that will probably show up in the economy as well. There is a lot of deregulation going on across the board on all agencies, specifically banks, the FDA, the SEC have a lot of deregulatory, removing regulations or loosening them, which could unleash a lot more, animal spirits in those sectors. Meanwhile, AI capex, it's massive, it's multi-year, it requires lots of materials and people and energy to build it all out. That will continue to be a strong tailwind. As long as you're in those sectors, your job and your salaries are probably going to be fine. Now, we talk about deregulation, but the Trump administration has also focused specifically on certain sectors. They're interfering on purpose. They're creating outsized incentives and stimulus for AI, robotics, semiconductors, defense, energy, quantum computing, and stablecoins. So those are tailwind sectors we just have to take care of, and keep into our portfolios. And finally, the Fed chair is going to be replaced because his term comes up next year. So we're going to get a new Fed chair in May of 2026. Whoever Trump chooses is definitely going to lean towards being more dovish. Whether or not they can actually pull that off, because don't forget, it's the Fed committee. Everybody needs to vote before they actually can agree on a certain change. So does everybody agree? That's not a given. But the Fed chair obviously has influence, and the next Fed chair is likely to be dovish and more stimulatory, wanting to cut interest rates. So we have that to look forward to in the markets and for the economy. I want to highlight here that inflation and prices were coming down on trend, but Trump's tariff war clearly caused prices to rise and break that trend. There's zero debate that tariffs cause prices to go up. The real issue is who is paying for it and when it shows up. Data is showing that producers in China are not absorbing the losses, while the US importers took the losses and have raised consumer prices slightly. Now that most of the tariffs are set per country, US importers are likely to pass on higher prices to end users. Remember, tariffs are essentially a sales tax on imports. It incentivizes less consumption of imported goods. But since the US simply cannot compete in making t-shirts and toys, it is austerity by taxation that necessarily weakens GDP. I understand that one goal of tariffs is to reshore manufacturing to the US, but building a new toy factory in Idaho, the math just doesn't work, and it's unlikely to happen anytime soon. As I mentioned earlier, the aggregate tariff rate on imports looks to be almost 16%. Yes, this year the US government will collect a record 200 to 250 billion in tariff revenue. But here's a thought experiment. If the economy sucks and consumers spend less, will reshoring happen? Will companies invest and build factories in the US? Or if reshoring actually does happen, will tariff revenues fall or rise going forward? Either way, tariffs cannot be a major source of income for the United States. Income tax revenue is like $5 trillion. So what does 300 billion do for the US budget deficit? Now, on to why I'm still concerned about inflation. First, on the good side, the cost of shelter is a lagging but large component of how inflation is calculated. And there are strong indications that shelter inflation is coming lower in the years ahead. Rent prices have fallen, home sales are very weak, commercial buildings are still fighting high unoccupancy, but the things driving inflation are many. Remember that if the US dollar weakens against other currencies, it means that we need to pay more for the same item than we did before. We essentially import inflation due to a weak dollar, and I believe we are still in a secular dollar weakness cycle. Here's a quick chart showing US dollar weakness since Trump 2.0. It's most likely a deliberate policy to weaken the dollar, which makes US exports more attractive and US imports more expensive. Globally, there are trillions of dollars of US dollar-based bonds outside of the US. There's a weird name. We call it the Euro bond market, even though it's not limited to euros or Europe. So when the US dollar weakens, it makes it easier for other companies and other countries to pay those debts. So far, U.S. imports have fallen as planned, but U.S. exports have risen only about 2%. I think this is one to keep tracking, and net exports is a positive for GDP. Having said that, net exports has been about a minus 2% impact on our GDP compared to consumer spending around 70%, government spending around 20%, rising to 20%, and corporate spending around 10%. Health insurance inflation. Ouch. For me personally, my health insurance looks to be rising again next year, and it looks to be somewhere between 5 and 10% range. The current US government shutdown has this as a key issue. Dems want support for Obamacare and to keep health insurance from spiking. As of today, election results overwhelmingly moved Democratic, and it looks like Trump and Republicans will need to blink first to end the shutdown. The AI data center boom is a huge energy user, and the current power grid is creaking as they try to quickly add more power generation. Net, we're seeing electricity prices spike up, and consumers probably don't know this until they see their electric bills go up, up, up. Another sneaky source of inflation. Climate-related events have increased in severity and frequency, forcing home insurance prices to spike as well. From 2020 levels, insurance costs have risen about 50%. Hard to forecast for climate disasters, but in the meantime, insurance companies are likely to keep raising premiums. Taking a look at the current economy and spending impulse, retailers are forecasting a lowly 3% growth this season. But if tariffs cause prices to go up by, say, 10%, that means lower retail activity but at higher prices. Cardboard box sales have declined all year, which is a pretty good indicator for real consumer activity. I think it reinforces that actual consumer spending impulse is weaker. Although West Coast port activity so far has been lackluster but stable, trucking freight activity within the U.S. has collapsed. Like the cardboard box index, this indicates a broad slowdown in economic activity that lies beneath the surface of GDP numbers and rising stock prices. It feels like either the economy needs to rebound to make sense of GDP and stock prices, or vice versa, stocks and the economy need to come down to reflect the current reality on Main Street. Additionally, we're seeing weakness in manufacturing employment as well. Overall, U.S. capacity is underutilized. A healthy level is 80%, and a robust economy can see levels towards 90%. This unfortunately reinforces to corporate America that there's no need for CapEx investment, as current factories and equipment are running at only a 77% load. The Dallas Fed recently published a survey they did with Texas energy companies. Our business has died is a bad thing to hear when it comes to U.S. energy investment and production. So far, Trump has gotten OPEC Plus to produce more, bringing higher oil supplies and prices lower. U.S. energy producers are not profitable at these oil prices and have zero incentive to grow production or do CapEx or hire workers. If Trump insists on keeping oil prices low to provide the illusion of low inflation in the U.S., this comes at the expense of the U.S. energy sector. We are now seeing signs that Saudi Arabia has also suffered low profits, and OPEC Plus may begin slowing production and exports. We could be heading for a period of higher oil prices in this transition, which may add to 2026's inflation. This is a super interesting chart. For homeowners with mortgages, the majority will be paying over 6% in 2026. Money spent on mortgages is money not spent on the economy. This could be a hidden and growing financial burden on top of the $1 trillion of student loans, which dampen consumer spending in 2026. As mentioned, the residential real estate market is weak and weakening. There are more sellers than buyers, low actual transactions, and despite a half percentage point in Fed interest rate cuts, mortgage rates are still above 6%. New home prices have fallen, while existing home prices are starting to fall. Technically, there's still a shortage of homes versus the population, but in a weak economy, we're seeing cohabitation trends and kids moving back home to save money. Unless the broad economy turns around, I suspect the weak housing market will continue in 2026. And let's not forget that commercial real estate is not recovered. Yes, work from home is now dead for the majority of corporate America, but AI is also allowing fewer workers to produce the same output. Demand for office space is not likely to rebound strongly. Meanwhile, the financiers of commercial real estate are quietly suffering and hoping for a break. Mid-sized regional banks are still on the hook and could experience more turbulence in 2026. As for unemployment and job creation, the reality is we used to need about 150,000 new monthly jobs to break even. But after Trump's immigration crackdown, the natural break-even level is now estimated at about 30,000 jobs. With the decline in the total labor force, a big slowdown in jobs posting and hiring, and an AI productivity-led round of corporate layoffs, I don't think the unemployment rate explodes higher, but maybe creeps higher in 2026. And despite the billions being spent on the AI build-out, overall construction spending growth has fallen below zero. Construction payrolls only reinforce the trend of construction employment weakness. And sadly, new college graduates are having the worst time finding a job in 2025. And bankruptcies are still rising in corporate America due to supply chain issues, tariff cost, demand weakness, and probably challenges to get financing or refinancing. Another really interesting chart, and the reason why I believe Trump has shifted his mindset and his measuring stick from US Treasury yields back to the stock market. Since home prices have stopped climbing, Americans are deriving their higher net worth from stocks. This is reinforced by the highest participation rate by non-professional/retail investors in history, at about 30%. This concentration in stock is dangerous and will likely impact consumer spending. If Trump can keep propping up the stock market, consumer spending will likely remain healthy, thus ensuring the economy is okay. But if we break the trend, it could be a double whammy of Americans feeling poorer and spending less. Here's a great example of the spending power and impact of retail investors in the US. Broadly speaking, institutional investors were pulling back from the markets in late September, yet the stock market continued to rise. Now we can see that retail investors bought the dip and helped drive the markets up. How long will this last? Do retail investors still have enough dry powder to buy the next dip and move the markets? Great questions, but we can't forget that 70% is professional investors as well. I don't have the answers, but suffice it to say that Trump will do what he can to keep all the balls in the air. And I think earnings pessimism is not anytime soon. Maybe Q2 next year, so we should lean towards joining the party for a little bit longer. For Q3 earnings so far, investors have been rewarded by most of the S&P 500 companies beating estimates. Though this is a bit hokey if you set expectations low, it's still a powerful psychological driver. Remember, it's not about good or bad earnings, it's always about better or worse earnings. At the end of the day, the US is still home to the overwhelming majority of the top 100 tech companies. Yes, China is growing and improving, but the current situation is an investor captures the majority of tech growth by investing in the US. Again, China has been coming on strong and has a lot going for their future growth. But the reality is the US has 3 times more computing power than the rest of the world combined. This dominant position is not easily lost, and the massive AI build-out in the US is to ensure that the US remains the top player in AI and tech. Looking out farther, quantum computing is another pivotal technology which both the US and China seek to dominate. It's in China's new 5-year plan, and Trump recently announced stimulus and support for US innovation in this space. Although there is much risk and uncertainty still in quantum computing, the risk of having all encryption broken by a functioning and a reliable quantum computer would devastate all encrypted communication and transactions. The stakes are high, and the loser could suffer a catastrophic cyber attack. When Trump declared trade war on the world, I was concerned that capital nationalism would prevail. I was wrong, as clearly foreign investors were pragmatists and bought the dip after the so-called Liberation Day in April. Remember, however, that the majority of international stock markets have outperformed the S&P 500. Foreign and domestic investors are pragmatic, apolitical, and unloyal to national boundaries. Going forward, investor dollars will flow to where it's treated the best. Right now, US tech is still the best in the world, but we can invest globally for other sectors. Now, underlying the global financial system, interest rates, and currencies is the US Treasury market. As you can see in the chart, US government debt is the main source of total debt increase over the last 10 to 15 years in the US. Historically, government debt to GDP above 100% is a warning sign of a country's imminent decline. Total debt to GDP above 300% is another natural level where we see countries losing their standing, as too much debt hampers productive growth. The US is not in a good position, but relative to the rest of the world, it's not the worst either. Recently, we're seeing liquidity tightness in the US as overnight reverse repos and bank reserves have come down significantly to critical levels. This may be due in part to the government shutdown, but regardless of the cause, it's likely to impact risk appetite when access to money is constrained. Conversely, once the shutdown ends, we could get a flood of liquidity to revive risk-on appetite. Now, managing the supply and demand of US Treasuries to maintain a stable, controlled, range-bound yield is a tricky thing to do. In fiscal year 2025, the US needed to borrow about $9 trillion, and they do this by selling US Treasury bonds. That's a lot of supply, and to prevent a shock in yields, Besant decided to sell more shorter-term treasuries rather than longer-term ones. First, this is exactly what Yellen did, whom he heavily criticized. Second, since we're selling mostly short-term bonds, that means we need to refinance those bonds again in 2026. So 2026 will again be a big supply of US Treasury type of year, and Besant will have to keep working hard to find buyers. If the Fed steps in to buy, which I think is likely once they install a new Fed chair in May, we essentially restart QE. Now, moving across the planet to China, they have a slew of challenges and opportunities as well. Starting with headwinds again. At the core of China's domestic economy is the real estate bubble that they popped and destroyed the average Chinese citizen's piggy bank. So, as home prices have not revived for several years, and that's where all Chinese people put their excess savings, Chinese are stuck and they don't want to consume and spend. Now layering in aging demographics, the COVID pandemic lockdown, we have massive youth unemployment. So we have a growing population of underemployed youth without the economic prospects of their parents. That we see similar activities in the US, but for China, this is a very big deal. During the Trump 1.0 years, China resorted to a policy that basically destroyed Western trust in China. You see collapsed direct foreign investment in China. You're seeing trade barriers go up. And the icing on the cake was when China supported Russia, Europeans finally said no. And basically that is a unified alliance against China's egregious competition. It will be a challenge for China to find a new buyer that is as wealthy and as big. And finally, if you understand Chinese culture, you know that we tend to overbuild capacity to get prices down. That is called, the new buzzword is called involution. China is aware of this problem and they are trying to address this problem. Recently, they've prevented price cuts for electric vehicles in China, and this has kind of thrown off all those car makers because they build factories, they keep lowering prices in order to get market share and volume. But once they start losing that, everybody loses and their profit margins start to collapse. So this is a serious issue for corporate China to figure out how they're going to manage this. But in the meantime, it is a negative for their economy. On the flip side, Trump's launch of tariff wars against the whole world has given pause to some of the only leaning to the US mentality. Basically, all countries around the world are now cognizant of not trying to offend Trump, but also building defenses for future self-sufficiency. That means transactional deals, things that benefit country to country, those are going to continue to evolve and they will leave out the US. And China has a role to play in that if they're smart and they're careful. Luckily for China, DeepSeek launched their AI the beginning of this year to great fanfare and shock to the world. They produced a highly effective AI chatbot that was orders of magnitude cheaper to operate. They are in the race and they are in the game. They were very smart to make it open source so that all Chinese tech companies can benefit from this, and also including the US tech companies. So they have now established themselves with a reasonable path of progress and success in AI. So despite falling exports to the US, China has made that up. Their export volumes have actually increased this year, despite all the trade war rhetoric and US-China conflict. And they've found growing exports to the global south and also to Europe. If they can maintain that, that would be great for them. But in the other side of the ledger, we have to remember that these global south countries are less wealthy than per capita, less wealthy than the US and Europe, and they're not going to get the profit margins that they used to. So yes, they are selling through, they're making less money on it, they're keeping the cash flow flowing, but for long-term success, it's still a challenge. Therefore, their new 5-year plan that they recently proposed this October, it is very interesting in that they're going to focus on overcapacity again in the future, but they want to focus upstream on that more advanced manufacturing. Lots of money for innovation, competition with AI, with defense. Energy is still a major component of figuring out how to power everything cheaply, which is a competitive advantage, and quantum computing, et cetera, et cetera. So they are going to double down with the innovation, and they're doing very well there. Finally, there's policy now that really wants to boost domestic spending. And in order to engage domestic spending for their economy, they need a wealth effect to generate the animal spirits. I believe that will be the stock market. The real estate market, they just can't fix. They've built way too much. It won't be resolved for many, many years. But the stock market in China this year has done very, very well. If they can keep that momentum going for a few more years, it becomes a credible place for Chinese citizens to actually invest for the longer term. Right now, it's a very speculative market, but if they can change the mindset and grow that wealth, they hope that the wealth effect will filter into their broader economy. Here's a fun chart that looks at the underbelly of China's debt and money situation. On the left, we see US M2 money supply at around 21 trillion, bank assets slightly higher at 24 trillion, and a US economy of 29 trillion that supports the above. In China, it's inverted. M2 money supply is 47 trillion, bank assets is 64 trillion, but the underlying economy is only 19 trillion. Now, I'm not an economist and don't fully understand the implications and risk, but I don't need to be an economist to know that bank assets being 3 times the size of your economic power can't be healthy. China is an autocracy and they can get away with illogical and closed structures for now. But if they expect to become a superpower someday, they must provide transparency, rule of law, and a free-floating, easily convertible currency, or no sane investor would risk having their money locked in China. US total debt to GDP is about 320%, while China's is about 330%, comparable. Digging deeper, however, US government debt to GDP is north of 120%, while China's is about 100%. On the surface, that sounds more responsible, but for China, this means that non-sovereign debt is much higher than the US. In a crisis, countries can protect their own sovereign debt by printing money, raising taxes, using the military to enforce calm, etc., etc. In the big picture, however, China may not be able to protect corporations and households. If a debt refinancing crisis happens in China, it could get ugly, especially since no foreign investors would be interested to come in and bottom feed. Again, to support the concerns about China's money supply growth, China's M1 money supply exploded higher after the 2008 financial crisis and kept going through the pandemic lockdown. Other developed nations also participated, but China's impact is outsized relative to its GDP. China's consumer spending component of their GDP is only 37%, compared to about 70% in the US. Conversely, they spend all their money on building factories and infrastructure, about 42% of their economy, compared to about 20% for the US. No doubt, China now enjoys dominance in many sectors like solar panels, electric vehicles, batteries, and rare earth metals, etc. But the flip side is they have overcapacity in manufacturing and they're very dependent on exports. China, for the long term, wants to reverse the directions of these trends, but aging demographics and competition with the West will be headwinds to achieving a more balanced economy. On the plus side, China is a very big and industrious country. Chinese work ethic is strong and they currently produce 3.5 million STEM graduates a year compared to 800,000 in the US. Digging deeper, over half of the US STEM graduates are of Asian descent. Recently, global rankings of universities is also seeing Chinese universities climbing into the top 100. China is producing high quality and nearly 4 times the number of engineers as the US. This is a critical success factor for a country to rise, as tech innovation has always been a powerful element of a country's long-term success. Now, this chart can be a bit misleading, as the number of patents in China's unique patent categories probably pad their numbers. Having said that, the sheer number of humans busy innovating and patenting new ideas is overwhelmingly in China's favor. China math applies here. Even if only 10% of their patents are actually new and revolutionary, the scale of China's manpower will still produce a mountain of innovation. For every Elon Musk or Steve Jobs, there are 3 of them in China. But they have managed to boost global exports to new highs as they divert their exports to the rest of Southeast Asia, the EU, and Latin America. Although exports to Global South countries probably entail smaller profit margins, as long as the volumes remain, Chinese factories will maintain enough cash flow and keep operating. My point being, the tariff war will not kill Chinese factories. The US is not the only customer in the world, and the world is clearly willing to buy more from China. China produces 75% of the world's solar panels. They've driven down the cost of solar panels by 99% since 1976. In a few short years, China has now become the biggest exporter of cars and electric vehicles in the world, by far. 6 out of the top 10 battery makers are Chinese. And China dominates with roughly 80% of rare earth metal mining and refining. The refining part is the actual bottleneck. Rare earth deposits are actually abundant around the world, but refining it is extremely energy intensive and ecologically dirty. This was China's main bargaining chip that forced Trump to back off with harsher trade war rhetoric. Now, we know that China is reliant on exports, but so far not overly dependent on them. Many European countries are actually more dependent on exports than China. China is also amazing with infrastructure. Not only do they build quickly, but they also do it much cheaper than the rest of the world. They'll retain their dominance in energy production, boosting solar, wind, and nuclear power generation, while gently reducing their dependence on imported energy. China is likely to have the lowest cost of electricity in the world for the next decade. But overcapacity has a cost. Here's a prime example of involution. BYD's electric vehicles are exceptional quality for a modest price, and they've exploded in popularity in global shipments. But with so much competition within China and a top-down mandate to ban reducing prices for competition, BYD finds its sales slumping and losses rising. This is likely to spread across all major manufacturing sectors in China's economy and put a drag on corporate earnings. And with the Western alliance in self-defense mode against China, foreign direct investment into China has collapsed, while FDI into non-Chinese countries has remained on pace. For Western corporations, you simply do not touch China, and Chinese investment in Western nations is being blocked on national security grounds. The world has split. China's only investors now are from the Middle East, which brings in money but no innovation or know-how. Finally, we get to the palace intrigue in the Chinese Communist Party. The number of Chinese generals who have been fired, arrested, or disappeared represents about 25% of the highest levels of the power structure in the Chinese government. Most were appointed by Xi and were deemed to be loyalists. They were removed on the pretense of corruption, but Xi's intentions are opaque at best. Is Xi losing power and was forced to remove his loyalists? Is Xi just simply reminding everyone of how powerful he is? Are the rumors of Xi's decline in health real and allowing the Hu Jintao faction to muscle their way into more power? I don't know enough to speculate, but credible China watchers are alert and monitoring. There's something here, even if we cannot predict how it will unfold. What is relevant is that since China's power is so centralized, any change in leadership will have an instant global impact. I think we'll have more visibility once we find out who replaces the expelled generals. If they are not Xi loyalists, we could have a problem. Now that we've taken a look at global shifts and the challenges and opportunities for both the US and China, here's a question that has taken up way too much of my headspace, so I thought I'd share it with you. For a while, I was obsessing over the tech war between the US and China. AI is such a powerful enabler of exponentially more innovation that whomever can dominate AI has a good chance of unleashing massive economic growth and prosperity. I used to think that whomever wins the AI tech war is likely to become the next and sole superpower. But after chatting to a brilliant friend of mine, I've changed my mind. Both the US and China have powerful resources and will be competitive in the tech war race. But the most likely path of the world is a bifurcated tech world, split along geopolitical alliances. The Western alliance will be led by the US tech, and they will maintain and grow their ecosystem, while the Chinese alliance will do the same, but with their allies. This great wall of technology will force the world to pick a platform and won't crossbreed, but both sides will have plenty of room to grow organically within their own territories. Essentially, both sides will remain highly competitive and grow, so it almost doesn't matter if one side is slightly ahead of the other. So after pondering that, I realized the race for supremacy may actually be more about which country can manage their internal problems the best. For the US and most democratic free speech nations, a divided America is the real enemy of prosperity. The friction of internal conflict is debilitating and handicapping pragmatic progress. Meanwhile, China is aging out and can simply lose steam before durable prosperity is achieved. If China backslides in delivering prosperity to the masses, their unbalanced mountain of debt could become the Achilles heel that unravels the government authority. The considerations here are broad spectrum, covering economics, innovation, geopolitical influence, but perhaps the most important factor is culture. This is a grand battle of ideology, and both great cultures will need to adapt to a new world reality and rewrite their social values and governance constructs. What exactly do people need, want, expect for their government to do for them? What is the purpose of paying taxes to a central authority, and what do we expect back from sharing our treasure? For Western democracies, this negotiation will play out openly in the media, in street protest, and will most likely be decided in courts and who is elected to represent us in government. It's a painfully long and messy process. For China, the back office makes all the plans developed by technocrat experts. But when the masses rebel, as they did when they forced Xi to stop the COVID lockdowns, the government must appease and back off, or do a modern version of a Tiananmen Square and squash dissent. For China, as the heat continues to rise, will the frog get cooked, or will it jump out in terror? Perhaps the answer lies in how gradual or sudden the temperature rises. My investment themes into 2026 have basically not changed that much since my last outlook. The only difference now is I believe the AI build-out trade, meaning more specifically semiconductors, is priced in. So I think there's more opportunity in the second and third order derivatives of what AI can do, specifically for productivity, robots in defense, and how it can help with drug discoveries, material sciences, and other innovation. Additionally, although much longer term, quantum computing is a government strategic directive both in the US and China and will enjoy a tailwind for years to come. Stocks are preferable to bonds, and outside of tech, I would prefer international or global themes rather than just being US centric. Brick and mortar bottlenecks in industrial metals and energy will also be needed on both sides of the Great Wall of Tech. For black swan risks, I've added Trump's health and Xi Jinping's palace intrigue. In a bipolar world led by the US and China, we have to be concerned about Thucydides' trap unfolding according to historic rhythm. The conflict is real and has been going on behind the scenes for a decade, but I'm hopeful that this conflict won't devolve into a shooting war. But only time will tell. Well, hope you've been entertained and provoked to think. Thanks again for watching, and feel free to share and reach out to me with your thoughts and questions.